All right, today we are diving deep into the very heart of what makes trading work: strategy. What is it that separates a smart, calculated decision from just, well, a blind bet on the market? Let's get into it.
And this really is the fundamental question, isn't it? Is this whole thing just a massive casino where we're all just rolling the dice and hoping for the best? Or can we actually bring a plan to the table, a plan that can really influence the outcome? Honestly, how you answer that question changes everything.
You see, you've got two camps. On one side, you have emotional trading. It's a total roller coaster, right? Driven by fear, driven by greed, and it just leads to these impulsive, random decisions. But on the other side, you've got strategic trading. This is all about being disciplined, having a plan, and following a set of rules. It's about taming that chaos.
So let's start right there. Let's talk about how we move from that chaos to a state of control, and how a really solid strategy can be your compass in the, let's face it, often stormy seas of the market.
So, what do we actually mean when we say trading strategy? Look, it's not some kind of secret formula or a magic crystal ball. It's simpler than that. It's your personal rule book. It's a clear framework that tells you exactly when to get in, when to get out, and most importantly, why. It's the difference between trying to find your way with a map versus just wandering around in the dark.
And every single solid strategy, everyone, is built on three main pillars. First up, your entry criteria. These are the specific, non-negotiable conditions that have to be met before you even think about opening a trade. Second, your exit criteria. This is your plan for closing out, whether you're taking a profit or, just as important, putting a loss. And third, and you could argue this is the most crucial of all, risk management. You have to know exactly how much you're willing to put on the line for any single trade.
And this right here represents a huge mindset shift. Look, a strategy isn't about perfectly predicting the future. That's impossible. Let's just get that out of the way. You're not going to be right 100% of the time. The real goal is to create a process, a set of rules that you can repeat over and over again that gives you a statistical edge over the long run. It's all about playing the probabilities.
Okay, so now let's explore two totally opposite philosophies that are really at the core of almost all trading. It basically boils down to one question. Do you try to ride the big waves of the market, or do you bet on them eventually crashing back to shore?
The first philosophy is wrapped up perfectly in this classic saying: the trend is your friend. Trend following is exactly what it sounds like. It's all about identifying which way the market is moving, up or down, and then getting in line with that momentum. The goal is to ride that wave for as long as you possibly can.
Now, to do this, you need the right set of tools. Traders might use something simple like a moving average crossover to signal that, hey, a new direction might be starting. But then you've got to confirm it. So they'll use an indicator like the MACD to see if there's real momentum behind that move, or maybe the ADX to measure just how strong that trend really is. You're not just trying to spot a trend, you're trying to figure out if it's the real deal.
Now, let's flip that idea completely on its head. On the total opposite end of the spectrum, we have what's called mean reversion. This whole strategy is built on a simple statistical idea. Prices are like a rubber band. They can only stretch so far away from their average before they tend to snap back.
So the toolkit for mean reversion is all about spotting those extreme stretches. A trader might use Bollinger Bands to see when a price has moved an unusual distance from its average, or they'll look at an oscillator like the RSI, the Relative Strength Index. When that thing climbs above 70, it's a sign that an asset is overbought and that the buying frenzy might be running out of steam. The whole point here is to bet against the recent move, anticipating that snapback.
So let's put these two head to head. Trend following thrives in a market that's got a clear direction, a destination. You're trying to catch that one big move. Mean reversion, on the other hand, is perfect for those choppy sideways markets where prices are just bouncing around. There, you're trying to catch lots of smaller, more frequent wins. They really are two different tools for two very different jobs.
But what happens when one of those quiet, sideways markets suddenly just explodes with energy?
Well, that brings us to our third major strategy, and this one is all about profiting from those sudden bursts of volatility.
We call these breakout strategies. The idea is actually pretty simple. You find a key price level, a ceiling or a floor, where the market's been stuck. When the price finally smashes through that level, all that pent-up energy gets released, and it often triggers a really fast, powerful move in the direction of that break.
But here's the catch. The big challenge is telling a real breakout from a fake one. And the number one absolute key is volume. A breakout that happens with a huge spike in trading volume, well, that tells you the market is serious. There's real conviction there.
Without that surge in volume, it's often just a trap.
Now these fundamental ideas, following the trend, betting against the extremes, trading the breakouts, they've been the bedrock of trading for a very long time. But today they've been put on steroids by technology, which has launched us squarely into the age of algorithmic trading.
Algorithmic trading, or quant trading, basically takes these rule-based systems we've been talking about and puts them on autopilot. It uses complex mathematical models to find opportunities and execute trades at a speed and with a level of discipline that, frankly, no human can match. It is the ultimate way to take messy human emotions completely out of the equation.
And this isn't just one thing. It's a whole universe of different approaches. You've got things like statistical arbitrage, which exploits tiny, microscopic price differences between related assets, gaps that are literally invisible to the human eye. And then you have strategies that use advanced machine learning to sift through mountains of data, looking for predictive patterns. It's a field that's just constantly evolving.
Okay, so we've got all these different strategies. Trend following, mean reversion, breakouts, fancy algorithms. So which one is the best? Well, you know what? That's actually the wrong question. The real key to long-term success is learning how to combine them. And that leads us to our final idea, building a truly resilient portfolio.
And here's the most crucial point to understand. There is no silver bullet. No single strategy works all the time. Trend following gets chopped to pieces in a sideways market. Mean reversion gets run over by a powerful trend. The secret is to build a portfolio of strategies that are uncorrelated, and that just means they tend to do well at different times and different market conditions.
Think of it like you're building a team. You wouldn't want a basketball team with only point guards, right? You need different players with different skills. It's the same here. By spreading your capital across different types of strategies, you create a much more robust system. So when your trend-following strategy is having a tough time, maybe your mean reversion strategy is picking up the slack. It just helps smooth out the ride.
And that really brings us to the most important takeaway from all of this. Success in the markets isn't really about finding the one perfect strategy. It's about a trader's skill in building and, maybe more importantly, sticking to a disciplined system that combines these different tools in a smart way. The overall system is so much more important than any single part.
So, there you have it. We've looked at the building blocks, riding the waves, fading the extremes, and combining it all into a system that can weather different storms. But you know, the real challenge isn't just knowing what's in the playbook. It's knowing which play to call and when. So the playbook is open. The question is, how will you design your game?